Hello ladies and gentlemen, and welcome back. Well, the sell-off that we thought might happen at the previous supply did occur over the last 24 hours. Of course, markets gapped up and they then moved down throughout the session. What's happening now though after the market hours is very surprising. Netflix, of course, has had a great return and it looks like they're putting on subscribers once again. On top of that, of course, optimism across the board is happening. But in today's video, we discuss the recent Barron's large money survey. We discuss breadth within the Russell 2000 and what that can tell us about markets potentially moving up in this squeeze that's occurring right now. And of course, we discuss the key levels that we need to be watching right now. We're in earnings season, guys. It's getting exciting. And guess what? Tesla is just around the corner. This is one of the big ones that we always watch. Stay tuned. We'll see you soon. Well, welcome back everybody to the Daily Show where we discuss markets around the world, including stocks, commodities, bonds, and cryptos. We've got a whole bunch of things to discuss today, but let's begin with earnings season, the big news events, the macro data, the lead statistics that have happened over time, and then of course we'll look at the key levels we should be watching right now. Netflix Q3 earnings beat with streamers adding 2.4 million subscribers. The numbers in a quick flash here, 7.93 billion versus 7.85 billion expected revenue. Adjusted earnings per share 310 versus 222, not bad at all. And subscribers net additions were up 2.41 million versus 1 million estimated. And this is led for the stock going 14% plus after hours. A very strong return here for Netflix considering everyone had of course, knocked it out. Now, we also saw some other big earnings. Not just did the banks do well, but also we saw some airlines doing pretty well. United Airlines posts strongest earnings in 3 years and just another stock that's having a good earnings season. So this is leading to that kind of bump throughout all of the stock market right now. And it still may be short-lived because, of course, what it tells you is the Federal Reserve may need to do more. It's very interesting. So what's happened in the recent days since we brought up this indicator, dumb money versus smart money? Well, we've seen smart money basically reduce its positioning and dumb money start to buy back in. Now, this has been traditional with a lot of those previous rallies. Of course, when we've had such a huge switch between dumb money and smart money, we've often then seen dumb money overtake smart money in terms of the purchasing. And at that point, when it kind of flicks it and it goes above, we've had to pay some attention. Notice back here over in the March-April period, and of course over here with the Fed pivot period that we saw just recently. So we'll be watching this and of course we'll continue to update you. Now we have Barron's big money percentage survey coming out here and the results are big money is supposedly very, very bearish. I mean, it's one of the highest bearish readings we've seen. We also had a massive reading back over here in 2020. It doesn't surprise us that we had a massive reading there when the survey came out, of course, in the heights of the pandemic. But yes, big money is scared. When we take a look here, you can see the bull versus bear percentage of the Barron's survey. And again, showing you that no one is feeling super bullish at the moment in terms of large cash. This is shown in really puts and also, of course, the options chain, which we'll discuss later in today's video. So when we get readings like this, what tends to happen? Well, it's often counter. Now, you'll notice that the readings that we've had in the past when we've seen these surveys like this have generally led to a little bit of a spike in the market. In fact, 1 month later after a survey result like this has come out, we've been up 100% of the time throughout the SP500. A very interesting stat indeed. Big eyes are now starting to turn to the smaller cap stocks. And we've discussed this now for 2 weeks. Small caps have held better than any other of the major indices. We didn't get a new low in the Russell 2000, and we're now in what is considered an incredibly strong time for the Russell 2000. The back end of the year, the last quarter and the first quarter tend to be those kind of strong periods, or at least the first month of the year. That's where we are right now, that last quarter, and this is where things turn around. If we look at the breadth kind of verifies that this could be a good period. I mean, we've had some pretty horrendous breadth readings. We're back down into this negative territory in terms of excessive pessimism. And historically, this has been a fairly major turning point for the Russell 2000. We'll take a look at the chart later, but it's very interesting to see here. Here are the stats for what the Russell has done when we've had readings like this on the breadth. And you'll notice that sometimes it's a little bit coin flippy for a month, but as we go out 2 months, 3 months, 6 months, and 12 months later, we tend to get not only very positive results, but also very, very nice percentage turnaround changes. And there's a few data points here, and you'll notice the worst ones always coincide with that scary point, which is 2008, 2009, which is of course what we're most correlated to in the markets right now. Some other things that are helping push this bullish sentiment have been things like divergence, SP 500 stocks that are registering 21-day lows during that recent drop-off. They weren't as many as you thought. You know, it was more the NVIDIAs, the Teslas, the big stocks that were falling over, but the broad market itself wasn't registering as many new lows. And that shows us there's a strong divergence. And again, there are some bullish statistics that come with this in terms of these signals. And we've got a nice data sample here and what happens next. All eyes still on the GFC though, because as we know, the global financial crisis, 2007 to 2009, that period there, we got some readings. And while we had a little bit of respite after that, we ended up going into what we call watershed moments. And that's what a lot of people are looking for here in 2022 into 2023. Now, what about the rest of the world? What about the rest of the asset classes? Are people feeling bullish? Here's buyer traffic for homes versus homes under construction. Look how many homes there are under construction, and people are running. They do not want to buy houses right now. Who could blame them, paying so much money in interest rates? Also here, home builder confidence, obviously dropping off now. Home buyer confidence already all the way back down into these serious lows. So again, the sentiment on especially housing is falling. In many countries in the world, housing builds or makes up a huge amount of the economy. For any of the Australian viewers out there, you guys would know that Australia is built on housing. It's built on construction. So if that kind of sentiment ends up seeping through for too long, it can cause serious problems in the economy. And obviously, if housing fails, then we've got big problems on our hand. Get ready for a global financial depression or something like that. S&P 500 midterm elections years. Is this where we get the turning point? Well, you can see whether it's all years around the seasonality, whether it's midterm years, whether it's first midterm years for presidents, Democratic president midterms, or second year new term Dems. It pretty much is the turning point for markets. This is exactly where we start to see that turnaround. And we've kind of gone a little bit early this year, which has been traditional to the seasonality. Effectively, we're in the back end of October now, but we've just hit that middle ground. And you can see usually that November or the back end of October into November has that big, strong spike with it. If the markets continue to do well, this could be the type of seasonality we look for, with further weakness just around the corner. In terms of all of the pullbacks throughout time, in terms of bear markets, over 200 years of data presents here with some stats. Pause the video if you're interested. And do remember that Fridays historically over the last 11 Fridays have been strongly negative. So even if we get big rallies here, watch out for those Fridays. The most correlated markets right now in 2001, 1973, 65 and 61, very correlated markets with this year. They all turned around this point and found some bounces. The only outlier from that was, of course, 2007. So historically, statistically, there are some nice turnarounds around this period of time. Now, we are in earnings season. We just saw Netflix come out. That gets a bit of the tick of approval. Airlines gets the tick of approval. Banks in general gets the tick of approval. And this one gets the tick of approval. So we are coming in relatively strong on the big companies. All eyes now go to Tesla Wednesday after the close. Can it continue the fairy tale story of how well it's been doing, showing that strength, showing the ramp in production, everything that needs to happen for a stock like Tesla to hold its valuation? This one I'll be very interested in as well. Let's see how the stock is actually correlating a little bit later in today's video. We'll talk about the VIX now. The volatility index is high still, even with this rally up. Remember, the harder it rallies, the more potential pain in the future. That's especially if it's very fast, what they call the dead cat bounce. Now, we haven't had a time where the VIX has gone over 40 in 2022, and that means that often we haven't reached the capitulation lows, that fearful period that often is synonymous with the bottoming of the market, something to watch. US 2-year, nothing happened here. It dropped marginally, 0.09% down. They're all very, very high. They're all at critical points. You can see here the previous kind of resistance or structure. We're reaching this illustrious 5%. If we look at the 5-year, very, very similar, just kind of sitting around this level. The 10-year, all important 10-year at resistance at this point. And if we go out to April of 2023, just remember, guys, we're set to hit 5% potentially from the Federal Reserve in 2023. So many people out there, so many of your family members, so many of your peers have absolutely no idea this is coming. They don't know there's still a lot of rate hikes on the horizon. They're starting to get an idea, but just remember, watching the forward yields gives you a huge edge in markets. And make sure to subscribe to the channel if you're interested in finding out more about forward yields. It's going to be the story of the next year to 2 years. It's going to give us great edge in many asset classes. Let's talk about high yield bonds. Basically, high yield bonds recovered again. This is a fairly positive signal. I mean, we saw high yield bonds recovering with the rest of the market, and only when they started turning around could we say, oh, wait a second, we made a series of lower highs coming on the way down. High yield bonds have kind of helped us to define whether markets are healthy or not. If the high yield bonds go past this level here, then that will signify a potential breakout in the stock market as well. So watch these high yields or junk bonds. They're going to be pretty important. And of course, I'll follow along with you guys on this. Investment grade corp bonds, again, held the highs for the day, ended up positive. A decent sign here for investment grade bonds. Let's move over to the US dollar, because this is where things get a little bit sneaky. It ended as what we call a long leg doji, a high, a low, an open, and a close at the same level. Now, some people call this equilibrium, some people call it fair value, some people call it indecision. It's not, it can be any of those really. I mean, I like to call it equilibrium. The market's kind of happy with its new price. But when we take a look at the structure here, we actually get a little bit of a turnaround story as it breaks past this high. And this was a good little rally level here for people that were trying to buy the dollar index in the previous market. In fact, this little low here, I would have thought that was a not too bad trade. Now, the longer it structures up here, the more chance this actually is just forming what we call distribution for the next fall down to the 110.80. But be very careful of new peaks forming here. If that does occur, we could see the US dollar strengthen actually, even though that's not our real case scenario, but it will link into the SP500 later on today's video. So be very careful around here, guys. The DXY is being sneaky at that last form of, I guess you would say, demand or support. The euro is doing something very, very similar. It's sneaking its way around this area of structure. Now, it's not predominantly at our area of supply or resistance that we believe sits around that 99.10, 99.20 zone. That's still our base case. We'd like to see it there, but this structure needs to break a new high. In fact, I would set a little alert to know it's moving towards that high so that you can then potentially target something inside of this supply in the future. That's going to be a very key level to watch. Gold is frankly terrible and boring at the moment. It hasn't done anything in the last 24 hours like we discussed, and I don't see any changes just yet. You'll notice here there's kind of like a series of lower highs coming through on gold, and it's getting more and more and more trapped, probably winding up for a large move. We haven't seen that yet. Now, a few people in our private community mentioned oil yesterday, and rightfully so. It changed after the video that we made, and I just wanted to show you guys the smaller timeframes. They were all going short, and I don't blame them actually. It was a really good little trade. So we saw this kind of continue to stuff around at our previous level of demand or support. And this level, it kind of broke underneath, which was already a very good signal towards the potential short. It came up, it caused like a max pain kind of breakout to try to trap cash. And it ended up starting to look like a Wyckoff pattern. So we got that, of course, that max pain area. We ended up seeing a little bit of a spring kind of here at the end. And then we got a new low followed by a rally. And of course, that was a big drop. Now, oil traders, if it does end up moving back up, they're going to be looking at potential shorts through this range. So maybe if we refine this a little bit, somewhere between this kind of little bull move could be further shorting for oil. So that was a nice trade. Congrats if you got that one. I'm not sure what the percentage was. Let's have a look here. So a lot of them were shorting through here. So about 4% to the bottom. if that's what they were looking at. And around this target or this area of structure would have been a good zone to target. So yeah, for now, oil remains in the negative. Congrats to those guys. If you're interested in joining the private community, you can do so on a free 7-day trial. Link in the description down below. Yeah, nice moves. Cool. Let's move over to XLP. So we'll get into the stock market now. This shows us consumer discretionary. So basically the American consumer versus the staple, the American consumer being a little bit tighter. And stock markets actually didn't end up taking the discretionary side in the last 24 hours. During this rally, we want them to be taking the discretionary side as much as possible during the rally to confirm that things are looking healthy in the rally itself. At this stage, that is not occurring as much as we would want. So we want to see continued XLY versus XLP, strong XLY. That's been what we've had during a lot of rallies. And if it starts to weaken, it shows us that effectively the stock market or the bigger players are actually going defensive during the rally. That's not what you want. If they go defensive during the rally, that could mean a dead cat bounce. If we look at some of the previous kind of points here, which was, let's say, this January 24th, you'll notice they didn't really pick it up very much, yet the market spiked quite hard. That shows us that they were mostly defensive through that rally, trapping people into the next move, which was short. Let's move over to Tesla, a big rally in the open. So we opened up high, we took out this little bit here, and now we've moved down. Theoretically, Tesla is setting for a buy type of scenario. It's taken a low, it's rallied up, it's taken this little high. In the short term, it kind of looks like it's trying to rally for bullish. I'm not going to guess on this one, guys. I don't even know. We're getting an earnings. If the earnings is good, then it should go up. If it really beats expectations, if it's bad, of course, the weekly prophecy will come true and we could spike all the way down very quickly to 180. I'm super interested to see what happens on Tesla. It's one of the last remaining strong beast stocks with really high valuations because of its strong growth and everything it's done. So let's find out. Yeah, it's going to be a big 24 hours. I wish we could give more insights, but we just really can't. We know where the gaps are. We know where the critical level is. And at the moment, we're structuring towards, you would think, more the buy side based on the small time frame. But yeah, we don't know what the result is just yet, do we? And the market's not giving us that many hints. It's not like Netflix where it was building an amazing base, getting ready for that earnings result. Apple here, we filled one of the gaps. So that's the gap that was through this close here. I guess that's a tick. We sold that zone. Again, another stock that opened up high and then sold off during the session. There was a great open, rally a little bit, sell kind of day, and it hit that top end or got very close to that top end kind of resistance. Now, if we break this, and I think it's worthwhile setting a little alert here just to know, if we end up breaking through these highs, we're kind of putting in a doubling bottom style candle formation. That could push Apple a little bit higher and again push us to that next squeeze level, which we'll be looking at when we take a look at all the indices very soon. Microsoft, very similar, opens up, goes down. Didn't quite fill the full gap of this previous island, but it's still very strong results for Microsoft across the board. Now we get into Netflix. Now at the time of this recording, it's up 14.34% in the post market. So it ends up about 275.40-ish. You can see here the post. And that's a very strong result in terms of how the market's taken to that. But look at the basing it's done over the last recent months. Ever since it took that second nosedive, the market has accumulated a position. You can see here, new low, scares, comes down, tests it again, bounces around, comes up, tests that resistance, and then it just structures up, getting ready for the result. And I think the big test here, or the big knowledge, was probably the weekly, where we saw fairly strong buy wicks coming off these previous levels and these levels here. Never discount the wick, guys. The wick shows us a lot of demand, and it was a fairly strong week, bit of a weak day. So of course people were selling, scared into this earnings because of where it was, but it came out and delivered the goods. A good first tech company coming out from the US. UK 100, nothing to report here, still holding our very strong demand zone. And if that gets taken, watch out for watersheds. In fact, I'm going to still set an alert down here to see whether we get a close under that level. That'll be significant. DAX moving on towards our downward trend line. If this continues to rally, this could be the problem level. So we will use the DAX. We will very much watch that 13,200 again. Worthwhile having alerts around that zone in the future, just in case it hits it, see how it interacts with that zone. It's been pretty good at calling a lot of the turning points for not only the European market, but also the US market. We'll move over to now to the Russell 2000. And this is where things start to look a lot better. Like you look at this Russell 2000 and you say, geez, that looks like a double bottom. And for anybody out there that knows technicals, double bottoms are often considered turnaround story patterns. Now, we actually made a new high in the last 24 hours. We've wicked the high. We've taken the high. We didn't close above it. Usually with double bottom patterns, you want a close above. But we've got a nice little kind of wick formation here. It's what they call an Eve and Adam double bottom. And yeah, it's the right type of configuration with the right type of volume. And we've got some strong kind of buying here through the midsection. So even if there's weakness in the stock market, you've got to think there's still potential for rallies and then potentially the big sell-off. Now, for aggressive bears, they're going to want to see it sell right now because they're drawing trend lines like this and they're like, yep, whatever, man, we're going to sell right here. And I'll show you why aggressive bears could feel like this level is certainly one. And it may be worthwhile for some people taking that shot. Let's have a look now at the Nasdaq. It hit the anchored VWAP that we pulled the other day in the previous video. Go back and watch that if you're interested. And yeah, it just tapped it and went bang, straight down sell. And it actually took the low of before the session. So we kind of had a peak, a trough, a higher peak, and then we took the low. And now at the time of recording, we've pulled back. If it's going to short, it kind of needs to do so here. Otherwise, it may move to take these highs. And that could be the next kind of short zone for the temporary bears. Or otherwise, we move into our long-standing levels, which sit around 12,000. And then, of course, the other one that sits around this 12,600 to 700 zone. Let's have a look at the SP 500 to get a bit of an idea here. Again, markets rallied on the open, then sold off aggressively through the session, came down, didn't quite fill the gap that was underneath here. It has now filled this gap, though, which was the 37.44. So that helped us define an area that we were interested in potentially shorting for the session. That's now cleaned up. So well done to anyone that had a go at that. It was a fair level. And if you were patient to activate a level like that, then, you know, well done and smiley face to you, because you had the patience to react or at least look for a good level rather than just guessing and going, oh, I think it's going to short here. I think, well, we don't really want to think. We want to try to stack the odds in our favors as much as we can. So we do have unfilled gaps around those lows. And if we move over here to the SP 500 in terms of the futures, you can see we actually tapped this supply and took it, which is the only real problem here. You wouldn't really want to take that generally. So you've got a peak, a trough, a higher peak. You've taken this trough and you bounced at this time of recording back up. It's critical. It kind of really needs to short right now. If it doesn't do so, then we take these highs, wick these highs, continue to move up. At that point, you would think probably take as well and wick the 3800. And then you'll notice I've got a little wick high here from the previous left-hand side. So maybe we come into this and have a little bit of a reaction off this towards the negative side. If we then go past that, 3880 to 3920. One of our beautiful base case scenarios here for a really nice where the bears kind of loom area. Both of these 4100 and 3880, 3920 zones hold previous structure and previous gaps, and they will be very, very interesting zones should we see the squeeze continue. Now let's just talk about squeezes, because markets that go up so fast are generally unhealthy and they are symptomatic of bear market rallies. Now, we have had a few of these. Most notably, we had this super aggressive one that came through in March and April. Now, a very aggressive rally like that is synonymous with bear market rallies. And that's the type of one that you're focused in on and you very much want to understand. If we end up going and we just rip all these highs and then you start just ramping and ramping and ramping. It's going to be very hard to pull the trigger on the short at that point, and it's going to be very easy to feel FOMO. Often these are the times that markets get you and they psychologically batter you down. Just remember, we are in options expiration week. We are currently at a price that is kind of fair market or equilibrium. And what we'll do is we'll refresh this. So you can see on the previous session, it was 375. Let's do it again. This is the big options expiration for the week ahead on the Friday. And now it's changed, but we just actually need to make sure we use the right one, guys. So still 375 at the time of recording. This will change into the open as we get all the data that's fed through. But what you'll find is that that's where we are. We're at the 375. Max pain is 375. So technically it's at max pain. But this will be a changing event. 4.7 million now units sitting here. And you'll notice that again, the 330, the 340, the 360 all act as put walls for the week. And these are the battlegrounds. 370 and 375 strike. Upwards of 390 is kind of where we see those calls. And I'll be watching what happens with these three strikes the most over the next couple of days leading into Friday. I want to see whether we get huge amounts of calls on this end coming through or here, so that we can kind of start to trap potentially a range within the technicals and the maximum pain. This is really the week we use it. It doesn't always work, guys. Just remember that max pain is no guarantee. It just helps you to potentially figure out where the market may want to move to for equilibrium reasons. Let's move over now to Bitcoin. And it was a disappointing session. It really was. Bitcoin sucked, but you could have actually traded it pretty well. So we talked about the idea that it makes a new low. It didn't quite ramp like you would do in terms of a short, just fell straight off. But what it did do is it fell straight into our equilibrium zone, our most touched trade zone. And then it found strong buys there. Look at that wick, bang, just went straight back up. So that shows us that there are buyers here. There is some commitment to, of course, Bitcoin. The stock market ultimately, I believe, is controlling this one right now. And I still think sentiment is weak. Because remember, the stock market went off blazing and Bitcoin has been stuck within these highs and lows. Just look at these candles on the weekly. Always go out to the high time frames. Long leg doji, rejection wick, long leg doji, long leg doji. It's just chilling, waiting for the next move. And I'm telling you, if we end up getting a new low, the way I see it is statistically the previous kind of times we've had Bitcoin winters or whatever you want to call them, Bitcoin weakness, we've gone between 83 and 86% negative percentage from top to bottom. That pushes us to 11.5 and 9.5. I think Bitcoin can do its own thing. Remember, there are certain big players out there. I'm sure a few of you know. They've got the laser eyes. They're lasering all over the place. But guess what? They're leveraged. And where are they leveraged? Where are they going to get hurt if the price comes down here? So you can only imagine the pain train that could be in. And remember who's involved in the crypto markets nowadays. It's not just us. It's not just us little peons like sitting there saying we're going to, we don't like fiat money. It's now the big banks. And Goldman and JP, they want the sweet value, guys. They want to come in and they want to try to take some of our shekels and our coins and our whatever they are, whatever we've got going on in the crypto world. So be very, very careful here. We are still in crypto winter. And while we could see rallies past this 20,500, which could push us up, we need to be very, very, very careful here. I particularly think in the crypto markets right now. In terms of the news for the week ahead, there's not much. Thursday, October 20th, we have the Philly Fed Manufacturing Index at 8:30 a.m. New York time. The rest of it, it's a pretty quiet news week, which is cool. But of course, that's because it's earnings. Never forget, next week, we have Apple, Amazon, and all of the big boys, Microsoft, all of them are coming. Google, Alphabet, they are coming out and they will be giving us the big reports. So if they disappoint, watch out, market. This is the time that we see those types of squeezes come through. Tesla, next 24 hours. Good luck. Subscribe, smash the like button if you're enjoying the content. And of course, we'll come at you tomorrow with another daily video. Bye for now.